Hey friends, welcome back to Random Gleanings. I'm Chris, he's Jesse. Jesse, we got a lot to cover today, and we're going to start with the good, but you really want to make sure to look through all these charts, pay attention. There's a lot of good stuff today.
Let me encourage you right now to subscribe. Hit subscribe button and keep up with us as we try and keep you informed.
That's right. So, okay, we're going to start with the good stuff. New one-year highs. You know, June of last year was not the bottom, but you know, we had a pretty good bounce in June of last year, so it was lower, and now you're looking at one-year highs on the NASDAQ and the S&P 500, which is nice, right?
Yeah, absolutely. That's. I mean, that can be a signal at times for sure.
Sure, it can, and the big question is it a new bull market? So, next chart, 4-year presidential cycle. You know, we're still lagging some. Relative to what you would normally expect. Usually year 3 is a very good year for equities.
Yep, for sure. You know, some of that trailing probably came last year in the decline, and you and I were talking, and I agree with your assessment that rates probably are showing an effect here, right? And so that's part of that, but it is well behind the historical norm of the presidency. And yet, if we go to this next slide, a guy we've referenced in the past, Ryan Dietrich, shows that when the market has been up like it has been this year, number one, this is about the time of year that things kind of level off for a bit, okay? But then it ends up high.
I like this comment down beneath in terms of what Ryan Dietrich is drawing from this. You know, all this assumes you know, some things in the past are there, right? Like disinflation. Is the Fed cutting? Are valuations cheap? Is the economy accelerating, right? So the big question is it? So next chart, our buddy Willie Delwich, he referenced profits in the first quarter. You know, profit margins are down relative to the past. They just are. With the exception of right during COVID, I mean, this is the lowest point we've seen, gosh, all the way back to, 2009, 2010.
It has been, and we are probably 10 days out, maybe less than that, from earnings starting, at which point I think banks come first, right? And we've done a lot of talking about banks, so it will be an interesting couple of weeks here, from here to see where the start of the earnings season, where that brings things.
And we don't have banks in here, but banks still look caught down in that post-Silicon Valley
collapse
debacle.
Right, yeah.
All right, so next chart. One of the big questions is, is it worth it to buy stocks relative to buying bonds? Mm-hmm. Because yields are higher. We know yields have been going up on cash. And so if you look at the price of stocks versus the risk-free rate, meaning short-term treasuries, which are yielding, like 5.3, 5.4%. Mm-hmm. Valuations look less attractive for stocks right here. And it's because yields have moved up so much. They're so much more attractive, right? So let's talk about inflation and yields and bonds a little bit, because that will have an impact ultimately on equities and what happens.
That's right.
Happens. So here's a mid-year economic outlook. Happy to share the link on this, but it's from Vanguard, and it's, sticky inflation most everywhere. So, Jesse, I keep hearing everywhere, hey, headline inflation's dropping, especially from the folks that have owned tech stocks in the beginning of the year, which, as we know, have done really well.
They have. Mm-hmm.
So here's a chart from Helene Meisler, who is a strategist historically in the past, but now writes for Market Watch, I believe. Really interesting gal, puts out charts every week. It's pretty good. Says this chart is my new obsession. It's the 5-year yield. I mean, like, how boring is that, right?
Right.
So
she's writing on July 4th.
Yeah, and she's writing on
fireworks.
Right. So and what she's implying here is that the yield is pushing back up on its trend line. Okay, right. So let's talk through this. Like, if we're in a new bull market and stocks are so good, and we've absorbed this situation where interest rates have risen and we're not going to miss a beat and we're just going to take off and have a bull market here, and the yield curve is inverted, and I've been telling you we're going to have a recession for the past, 12 months? At minimum for the 10-2s.
Yeah.
And for the 10-year 3 months, it's been since October of last year, so that's 9 months. Right? And like the 10-year 3 month is like the big one, right?
Right.
So what's happening here? Are yields breaking out? That's what she's trying to say here in this chart. So here she is on July 4th saying, hey, the 5 years at 419. Is anyone else obsessed with this chart and paying attention to it? Well, this morning it's 4.42%, which means as of the day, it's broken out. So this next chart is the yield curve, okay? And I've got the 5-year circled because of Ms. Meisler's comment. But you can see here, everything on the yield curve now has a 4 handle as of this morning. Is that going to continue? Tough to say. The 10-year and 30-year are both pushing up against new highs. But what's it implying, Jesse?
Well, I mean, it would imply that the economy can handle these higher rates, which the Fed has been saying higher for longer. And if that's really the case, if that's not going to push us into the recession that the inverted yield curve historically would be a signal of, well, then it's time for the longer end to start to come up, which would be odd given that last year was a negative year for bonds, and that would be setting us up for likely a negative year for bonds again this year.
So what we're seeing from strategists is like this barbell. The folks that have felt very good about equities in the first half are saying yields are going to roll over,
right,
is what I'm reading.
Right.
That's not what's happening.
That's not what's showing. Okay. That's exactly right.
And on the other hand, the folks that have been more hawkish about the market, more concerned about things for stocks, right, are saying, look, if times are so good and everything's going to be a party going forward, then that probably means the long end rises. But why does it rise?
Because I mean, one, as a bond investor, you have to get a real yield to incent you to go buy that bond. And so if inflation is going to stay higher, which we've pointed to or are about to point to in regards to where, we've not seen the core inflation start to come down, well, you've got to get something that's going to represent a real return on your bond investment.
So let's talk about that because, again, this is a little bit of a complex topic, and we've got to have balance in all this.
That's right.
Okay, there's a chance that equities do fine. Okay, but there's also a real chance that having good amounts of cash makes sense too.
Well, I think this is the thing: is that yes, if equities do fine, it's going to bring the long end up. Correct?
Yeah,
right.
You would think if there's inflation. Now, if it's disinflationary and this is 1995 all over again, because all of a sudden artificial intelligence is going to make the unemployment rate rise, and yet we're going to lower inflation and all this kind of stuff. It ain't happening yet.
Right.
That's the issue here.
Right.
Okay. So let's read a little bit about this. Okay. So this is from Investopedia, the Fed preference for what's called the PCE price index. That's the personal consumption expenditures index. And they've said in the past that, hey, we like this better. And it's really because it has more services in it, right? Mm-hmm. We've talked about
Which
this.
Is more representative of our economy right
Correct.
now. Mm-hmm.
I mean, services are 85+%, something
right.
like that.
Yep.
Okay. All right. So next chart. Here it is. Core PCE crested in February of 22. All right. And it's running at 4.6% with the Fed's inflation target of 2. That is a 2.3 times the target through the first half of this year.
Right. Well, again, you see on the last slide, they say this is their preferred target in inflation index. It never got to that 9 number, right? It only got to just north of 5, right? And it just really has not moved. And now it's come down some. It's settled.
But listen, it's gone sideways for effectively 17 months.
But the big headline number is what grabbed everybody's attention, 9.1 June of last year. And that's come back down to where are we at now? Just north of 4, something like that. Well, this is now higher than the headline number. And this is the more important one to the Fed.
Yes, it is. Now, let's look also from a different angle at the median consumer price index, which we've talked about historically. This is from the Cleveland Fed. Okay. So the orange line is median CPI. That is the middle data point. And again, these are year over year numbers, but what they do is they take that median data point, which could be rent this month and could be eggs next month,
right.
Okay, or gas the following month, right? And you add up each month's increase, and what you can see is the median number has stayed higher.
Yeah.
In fact, it's 6.74% through last month, which is 3.3 times the Fed's target of 2% inflation. Now, in 1997, because I did some research on this 16% trimmed mean CPI number, so it's optimized, right? They take a little bit of noise out of the median CPI. It's running at, and this is a paper from 1997, okay? It's still running at 5.5%, which is 2.7 times the Fed's target. It ain't over. It's not over.
It's not over. That would justify, the long end needing to come up, okay? And what you said earlier is the big tech names is what's just dominated this year. And the kind of mind melter for me is,
that's the stuff that's supposed to be that bad in an inflationary
be
environment.
Rate sensitive, right? And so I think for me, it is one of these situations where what do you believe? Do you believe the momentum in the stock market? Do you believe the momentum in the technology names? Or do you believe what has historically been called smart money in bonds? Because we're on this precipice of sorts in regards to something's going to happen in one of these that's going to probably bring the next leg.
So, listen, there are other types of risk assets besides tech as well, right?
Oh, yeah.
Industrials. One of the things that we've seen is that, yes, producer prices, meaning wholesale prices, have been dropping, and that's good. And obviously, shipping costs, the supply chain, all those things, it has been getting better. There are things that will make money, okay? But the issue is, so we can't stop owning risk assets, right? So we've got to be balanced. We've got to have some risk assets, but we've also got to be open to the fact that cash yielding 5+ is not a bad thing either.
Again, going back to the equity risk premium, it seems to be a equal or better value right now as a hedge for sure.
Indeed.
Yeah.
All right. That's all I got. A lot to unpack. Stay tuned. It is a really interesting time.
It sure is.
That's all I got.
Yeah. Well, belated happy 4th. Hope everybody stayed safe, and we look forward to seeing you next time. Hit subscribe, share it with a friend, and check us out again next week. Take care.